All right, by my clock, we've reached 2:30. So welcome everybody to the May installment. We just fit it in for this month, but the May installment of FactRight's monthly webinar series titled Rethinking Due Diligence and Manager Selection. My name is Scott Smith. I'm President and CEO of FactRight. For those who don't know us, FactRight is a third-party diligence and risk management consultant to servicing financial advisory firms that offer alternatives to retail clients. So I invite you to check out our new website. We just launched one last month, factright.com. And you can stay connected to us by subscribing to our new blog, and you'll find that subscription site on our resources page at the factright.com website. A couple of housekeeping items. First, there'll be no Q&A. We're recording this session. There's no Q&A, but you can certainly always email Scott@factright.com. You see that listed there on the page. This is going to be a pure interview session, Q&A with Tom Brakke, who I'll introduce in a second. So there will be no slides, but we will be talking about handing a handout after this session concludes. So you'll have a takeaway based on the webinar. You also have access to the recording of this webinar, which we are recording it currently. So be able to replay it and distribute it to somebody within your firm that might be interested in learning more about rethinking due diligence and manager selection. So again, that's our topic today. Why should we rethink due diligence and manager selection? So the approach we're going to be exploring with Tom, maybe one you're currently using, but based on our experience, most of you are likely using a process of standardized documentation. That approach, like any formal due diligence process, is better than no due diligence process. But we think anything worth doing is worth doing well. Diligence analysts that use a standardized approach to focusing only on areas like past performance can miss opportunities to discover the defining characteristics of organizations, and what defines a firm tells the real story about that group. So while the past is certainly an indicator of the future, when analyzing investment managers, it's a poor indicator, we think, particularly when compared more qualitative analysis based on the organization of the investment management firm. So we're lucky today to be joined by Tom Brakke, principal of TJB Research, located in Excelsior, Minnesota, right down the street from FactRight's home office. Tom is a consultant, writer, and investment advisor who specializes in helping investment firms and institutional investors with decision-making processes and organizational strategy. He spent 15 years with American Express Financial Advisors, notably as president of Advisory Capital Strategies, the firm's alternative investment division. He taught research and investment analysis at the University of Minnesota and was assigned as the consultant for an investment bank who needed to form an independent research program as part of a large legal settlement. Tom is a chartered financial analyst and is a member of the CFA Institute's approved speakers program. So Tom, glad to have you. Thanks for joining us today.
Thank you for having me.
So we'll start right at the top. We've got a number of interview questions. We're going to take about 35 to 45 minutes, hopefully today, with Tom to go through his perspectives on this topic, and we'll start right at the top. So Tom, describe why diligence is important for advisors who owe a standard of care to their clients, and then how do you distinguish a process of documentation versus a process of discovery?
Well, I think first of all, it's just that standard of care is just, and there are different, obviously, standards that apply to different types of advisors. So we won't delve into that whole thing. But in general, you've got a responsibility to, investigate and pursue information about investments that are chosen on behalf of clients or recommended to clients. And so how do we execute? How do we exercise that standard of care? And I think, we're rightfully, to a certain extent, forced into documentation for legal reasons, both to protect ourselves and to meet the requirements that we have. And so it's easy to go through and kind of check the boxes off. And we've kind of, I think, built a culture of documentation. So doing due diligence, if you will, amounts in some cases to checking the boxes, doing that documentation. And you really lose what I think is the important part of the due diligence process, and that is discovery. I use I often refer to the movie All the President's Men, which most of the maybe older generation that's on the call would have seen, and perhaps not as many of the younger ones. But it's the story of the two reporters that unwound the Watergate affair. And obviously their goal is to document what happened. But it's a great movie in showing the process of discovery and how they dig for details and how they don't stop with the information that they've been received, that in this case the powers that be, the president and everybody else in the Nixon administration, the stories that were given out, and they kept digging and kept digging. So it was the discovery part of the process that really made the difference. You need to do both, but too often we forget about the discovery process, and we're just trying to fill out our checklist. We're just trying to get our report done, and that leads to sort of being blind to other possibilities for investigation.
So excellent. So if we were to deconstruct this a little bit, let's assume we were to start new and have to build a new due diligence process from the start. What are some of the fundamental questions that we should be asking first behind that process that are typically overlooked by advisors conducting due diligence?
Well, really basic ones are sort of, what am I trying to do here? Why am I doing it? What's the purpose of it? What am I trying to get at? What am I trying to attain by doing this? And then how do I go about doing it? And I think there's a process of self-analysis that I think, in a series of questions that I think are important. And when I say self-analysis, I mean both for an individual and for the organization that they're a part of. I'm speaking at an AICPA conference in a couple of weeks, and I sort of laid out a series of questions there, and I'll just walk through them. They all take the same form. The first is, what beliefs do you have? Because depending on the nature of your beliefs, if you believe markets are efficient, you're going to go about this process a lot different. You're going to end up in a different place. And so it's really important to understand what beliefs you have, what resources you have, the skills that you have, the access to information that you have, the structures and processes you have, and the governance that you have. Now, for each of those, you may be at a certain point today. So aspirationally, you can say, okay, what do you need? What beliefs do you need? Resources, skills, access, structure, and processes do you need? What governance do you need? And really, along each of those questions, in response to each of those questions, it's really important to try to identify how you can add value to the due diligence process. So resources is obviously a key one, because you've got different kinds of organizations, different sizes of organizations. And so you really need to match what you're trying to do, how you're doing, with what you're able to do in terms of the situation. Or if you're building a firm, or trying to improve a firm, getting on a path where you are actually building something that you can attain what you want to deliver in terms of the capabilities. And in a lot of cases, when I look at organizations, I see mismatches in that regard, that the factors that I just asked the questions about aren't in place to be able to effectively deliver what you're after is to understand these organizations and to select good managers. You can go right down to the most global one of those is governance. And in a lot of cases, there might be issues with, how investment committees are organized, how decisions are made, those sorts of things. So you can do all of the work that you want to do detailed in terms of building that documentation, discovering things about a manager, and if the governance process fails, it's probably all for naught. So each of these pieces needs to be put together in a way where they fit with each other and they fit with the circumstances of the organization.
Yeah, I think that's really smart. I think you have to do a self-assessment of the resources you have available. But beyond that, how do you take next steps is, we're all about mission statements here, or at least purpose statements. Mm-hmm. And unless you have a purpose behind the question you ask or the document you request, it could be just costs and expenses as opposed to real value in the diligence process. So it starts globally and with a understanding where you're at in the process.
Yeah, I mean that's an important thing to remember in terms of trade-offs, because we all work for organizations that are trying to not only deliver value but to make money themselves, and so to make good choices. And frankly, one of the things that comes into play is that people doing due diligence are so stressed in terms of trying to, get every piece of information, print out every chart, have every sheet of statistics, do all that kind of stuff. And it doesn't really, and some of it isn't expensive anymore. You can print out data till you're blue in the face, but does it really add value, and is it the right place for your attention and your resources to be delivered to be able to make the kinds of decisions you need to make?
And you and I were talking before the webinar about training and the lack of proper training to new analysts in the due diligence arena, and how that's a needed resource that needs to be delivered a little bit more. So talking about resources again at the firm level that's doing the due diligence, a lot of advisory and broker-dealer firms are of a lot of different shapes and sizes. Scale and resources are different depending on how big or small they are. And then you can break down investment managers into active versus passive. But let's start with the advisory firms themselves. And can you just highlight where you see a small-sized firm, a mid-sized firm, and a large enterprise-level firm? Where are the challenges that around diligence that each one of those types of firms have, based on your experience?
Well, a small RIA or sole proprietor even, or somebody who's a part of a bigger organization but doesn't get a lot of support, obviously is resource challenged. They're pressed for time. I'm a sole proprietor. I don't function in terms of doing. I don't manage money or anything like that, so it's a different kind of thing. But I just know as a sole proprietor, I'm always pressed for time and stressed out over one thing or another. But also lacking, the kind of resources for the analytical tools you might have. You typically have difficulty getting access to managers and other people that you want to talk to. You don't get a lot of free research, all those sorts of things. So for a small organization, those are real challenges, and probably means that you need to narrow your scope in terms of the kinds of investments that you can consider, because it's virtually impossible to do effective research and due diligence. For bigger organizations, and who knows the scale of organizations these days, are obviously we've got huge wirehouses, but we've got RIA firms that now, I think there's something like 2,000 that are $1 billion or larger. I mean, that would have just been unthinkable a few years ago. So in that kind of a firm, it's a really question of a lot of times about where the decisions are located in terms of who makes decisions, so the governance, are investment committees present? Is there effective? Are those investment committees effective? Depending on, again, the role of advisors in there, what the differences of opinion are among the advisors. In many cases, the investment staff the investment function is understaffed in these kinds of organizations. They've been growing, but they often grow more quickly at the advisor level and focus more on practice management than on the investment function. And then a lot of times there's sort of, especially if these are roll-ups or other kinds of situations, you've got different cultures within an organization that starts to really work against each other. And so when you get to those beliefs questions and then how decisions are made, what we're really trying to do as an organization, all that basic stuff, sometimes gets lost in an organization that of that size you think wouldn't have those kinds of problems. And then there's the really big firms, both RIAs and broker-dealers. And there you get into situations where there's probably some dedicated resources for due diligence and manager selection, but the quality of them varies pretty greatly in my experience. And so how do you think about internally what the quality is that you provided of the information? How do you assess that? I think you kind of approach it sort of like you do with a third-party provider. you can run into proprietary product issues, obviously, if that's a main part of what the organization is trying to do. There's a lot of potential landmines there. And just because something has been cleared by due diligence, is that really, what does that mean if it's been cleared by central due diligence? What does that mean for an individual that's working with that in that kind of organization in terms of their responsibilities? So much different kinds of concerns and problems that these different shapes of organizations face.
That last point is one that we experience quite a bit, and historically has been the broker-dealer model, where an advisor selling a product or offering a product to a client, if it's been cleared by diligence at the home office, they assume that the work is done in terms of diligence. And I think with the DOL and the fiduciary duty rules, increased just general lowercase fiduciary FD presence in the marketplace and the trend that's growing, I think that even for registered representatives and broker-dealers is becoming an outdated model that needs to be addressed.
I think the suitability, I'm not an expert on the rules, but the suitability rule is a pretty low bar at the firm level, because it's basically, would this work for somebody? That's the basic first bar that you have to step over. That's not much of a bar, and so it seems to me now, as you indicated, with the changes that are going on, and really a lot of these big firms, you can see that they're coming out in different places in response to the DOL rule, in terms of whether they, even if it goes away, whether they would stick with it, et cetera, et cetera. So you're seeing a lot of experimentation, a lot of different avenues that are being taken by these large organizations.
I've heard you say that numbers and stories form the basis of how we make decisions, numbers and stories. And everybody knows on the call who's done any level of diligence that numbers and stories present multiple traps for diligence analysts. So can you highlight some of the blind spots that you've seen within these two categories?
Yeah, I think there's a fairly recent development. I mean, really, just in the last couple of years, you hear the phrase evidence-based investing, and it's gotten to be very, very popular. And so I think there's a lot to be said for it. But the downside of evidence-based investments is, what's the evidence? Well, we go back and look at the numbers. We go back and look at what's done best. We'll go back and look at what the historic return is, or volatility, or correlation, and we sort of get lulled into the sense that this is some kind of truth, that there's proof here. Well, there's no proof here. This isn't physics. This is investments. This is behavior. This is a social science, and so it's really easy to get tied down to a limited viewpoint of historical numbers. And most of what we look at is within my career, which is 35 years. And if you look at that, it's been a one-way street. It's been lower inflation, lower interest rates, higher stock prices, more globalization, more information flowing everywhere. And so it's only been really one kind of environment. And so it's really dangerous to get hooked on those historical numbers and not try to look back to other periods to the extent that we have information, but we lack a lot of information in that regard. But also to imagine what happens going forward in different kinds of environments. So perspective, a look at scenarios. And there's a lot of there's a lot of traps we can fall into. One that I particularly point out a lot is Sharpe ratios, because a lot of people in the business, from big institutional investors to retail investors, look at Sharpe ratios and make a conclusion about what they mean in terms of who's better and who's not better. And if you go back and look at what William Sharpe himself has written about it, that's just a misuse of that statistic. It doesn't have the kind of power that people attribute to it. It's viewed as a kind of a gold standard. It's one measure that you should have in your toolkit. So I'm not saying discard it, but to overuse it is a sign of how we really get trapped with the numbers. And of course, performance chasing in all its glory is the big one, because we really have a hard time getting away from following performance and having performance affect how we view everything else about a particular organization. Everything gets cast in the light of the performance.
Yeah, one thing you've mentioned too is reputation. I've heard reputation's a lagging indicator. Right, so the future performance is from today's organization as it is today, and the real, and we'll talk about in a second, the real organization is kind of hidden from the surface view, which is pressing why the quality of the organization, rather than some of these quantitative metrics, is more important to understanding and doing diligence on a manager going forward.
Yeah. I think that regarding reputation is that so much of the reputation or interpretation of how good somebody is based upon that performance, and performance is a lacking indicator. Therefore, reputation is a lacking indicator, and there's many examples of that where somebody is very highly thought of for a long period of time, and then their reputation disappears. Well, why does it disappear? Frankly, it's because performance starts to suffer. Well, that's not a very good reason. A lot of times there are signs before that within the organization that could be identified.
Mm-hmm. So performance is one of the 4 Ps that you use as a handy reference, and this is a reference really to kind of a standard qualitative evaluation. You're getting off of the standardized documentation approach and onto a qualitative evaluation of organizations. So talk more about your 4 Ps approach.
Well, so that's that's how it always was when I got into business. There was 4 Ps. In this presentation that I mentioned, I actually have listed 12 Ps because apparently you can't come up with a criterion that doesn't start with P, but 12 different Ps that different organizations have come up with. So you'll hear 3, you'll hear 8, you'll hear 6, you'll hear all these different sorts of things. If you boil it down, the sort of classic way of doing it was philosophy, people, process, and performance. And I think that even though it's old-fashioned, I think it's probably a good structure to use to try to evaluate an organization. Obviously, philosophy is understanding what they're trying to do in their investment approach, and really not just superficially understand, they're a small cap growth manager, or they're doing this kind of an alternative or whatever, but really understanding the nuances of their philosophy. It also gets into comparisons to your own beliefs that we talked about earlier. People is a really easy one to get messed up on because what is people? Okay, so that firm's got 5 people from Harvard and 2 from Yale. Is that better than somebody that's is from the University of Minnesota like me? Only it took me 2 times to get through school. I mean, how do you it's very easy to make a superficial judgment about people based upon some things that don't really matter. In fact, if you're looking at putting teams together, another smart person is highly unlikely to improve the team. What you need is different kinds of perspective, different kinds of people. That's what makes for more effective teams. So how we assess people is very often off the mark in terms of trying to figure out, can this group of people within the context of that organization deliver going forward? Are they building their human capital in a way that's likely to have them be successful going forward? That's really the question. And that question doesn't very often get asked in due diligence. And then process is, a really good example of how we can, we're going to talk a little bit about narratives here in a second, but how we can get off track in terms of believing that the process is something that the manager tells us it is, and that appears in a pitch book or in a fancy graphic of some kind. That's the marketing process. That's not the real process. And so trying to figure out what the real process looks like, where the issues are, where the potential problems are, is really an important aspect of the due diligence process.
Mm-hmm. Yeah, so you jumping into it, because I love the term narration creation machines. You use that to define investment management firms, and that's a necessary term because they need to tell their story, They need to market their thesis, but diligence analysts get caught up in them, and they probably do it without knowing it. Maybe some are complicit, but very few are. They probably get caught up. And it reminds me, of the sales process, where either salespeople are operating according to their process and kind of controlling the flow, or they're caught up in the buyer's process, and that's no place you really want to be when you kind of lose control of the situation. So introduce us a little bit to this idea of narration creation and where these pitfalls are for the analyst.
Well, I think, as you mentioned, a lot of times we don't even realize it, that we've been affected by it. I mentioned biographies earlier. So a lot of times what you see in the people section of a due diligence report is, cut and pasted information from the manager as to the people's biographies. No interpretation, no nothing. It's just cut and pasted. Well, you can say, well, that's facts. Well, we can argue about whether that's facts or not, but it's clearly the narrative that the manager wants you to see, and that it's most obvious in that area of a report, but you see it throughout reports where a description of the process, a description of this, some relation about some view on some investment idea and it might be lightly paraphrased, lightly edited or altered. A lot of times it's really just passing off that narrative. And one of the things I think that due diligence analysts should do is to make it really clear when something is that close to the narrative of the managers. In other words, it's fine for me to literally quote it. Use quote marks, because that's what it is. Use quote marks and then provide commentary. We agree with this characterization. We disagree. Here are the issues with it. Here are the problems with it. All those sorts of things. But the easiest thing when you're doing a report like that is to lift ideas and even phrases and even whole sections from the manager themselves. And so you're just adopting that narrative without ever even realizing it. And you end up passing it off then to whomever you're talking with in a meeting, whomever reading that narrative. They can't see what your opinions are as an analyst. They're seeing this mix of information that's some of yours and some of the managers, and it's not clear whose is what. And so the narrative really becomes yours. And so the manager has, in effect, captured the analyst by doing that. It's not the manager's fault. So the capture is not the manager's fault. It's the analyst's fault. The manager's job is to create the narrative in that scenario. The analyst's job is to crack that narrative and understand what they think makes sense in it and what's real about it and where they have questions and where they have problems with it. And so the failure is really on the analyst's part and not disrupting this narrative.
One area that you've said, buzzwords come out of these narratives, and one buzzword we hear a lot is consistent and repeatable. And our process in particular are consistent and they're repeatable. And if they take it at face value, that sounds great, and that's the way your report might read. But if you go deeper with that level of skepticism that's needed, you find, right, that most processes are not that consistent and not that repeatable most of the time. I mean,
it's a marketing phrase. I use lots of things. I've been quoted as saying it's a crock, it's a ruse, it's a whatever. But when someone says they've got a consistent, repeatable process, start asking questions and find out what's consistent, what's repeatable, why. I think that if you're looking at, there are different kinds of vehicles we can look at. Obviously, we look at an index vehicle that's meant to be consistent and repeatable because you're replicating an index in some way, shape, or form. If you're looking at a quantitative approach in terms of factor investing, there's a lot of that is meant to fit with a model and be consistent and repeatable. But when you're talking about active managers, the reason you're hiring them is to be able to understand the nuance in the marketplace, to apply their general philosophy in a way that's as consistent as is reasonable under the circumstances. I mean, this gets into lots of really interesting questions because a lot of investment roles for all of us are going to change over the next few years as we disaggregate them as they're currently put together into the parts that machines do better and the parts that humans do better. And so if you're looking for the consistent and repeatable parts, that's really more like machine work. You don't really need people to do that. What you need with people is to understand the nuances, as I said, of the markets of a particular situation, to apply the philosophy and the general process that you're looking at. So it's the general process and how it's built and how it's put together and that's consistent and repeatable is just too strong a word for what really happens in the best human-driven investment processes.
Mm-hmm. So I think we're getting kind of an understanding of the type of person that's best to do this diligence work. Obviously, somebody with a healthy degree of skepticism, more training and experience is always needed, but I think those with a healthy degree of skepticism. So let's assume we have the right people. Maybe we start now talking, and we understand qualitative analysis is now critical, maybe the most critical thing in the diligence process. Let's talk about how we start practically maybe incorporating some of these practices in the diligence approach if we haven't already. Maybe starting with on-site visits. Talk a little bit about best practices if you're on-site, and let's assume maybe you don't have the resources to get on-site, but you have access to management over the phone or through Skype. How can we still accomplish the goals of that type of that part of the diligence process?
So I'll just go through kind of three different categories. I mean, these blend together, but I'll talk about three different categories. The first one's an on-site visit, and which is that kind of field work provides you with the best information that you can get. Just showing up doesn't. So you need, you need to do it in a thoughtful way. Somebody once sent me a note saying, give me some tips on this, and I wrote them 7 things, and I kind of have kept with them. It's not comprehensive, but I'll just read them off to you. I try to have one-on-one meetings with as many people as I can. Some group meetings can be fine, but if I had to make a choice, it's one-on-one meetings, because I'm trying to understand how each part of this process works. And as I often say, and I say it directly to chief investment officers, you often learn more from a junior analyst than you do from a chief investment officer. It's not because they tell you stuff they're not supposed to tell you. It's because they're closest to the work. They see how the pieces come together. So that's first, one-on-one meetings. The second one is really important. It's my agenda, not theirs. I run the meeting. We go where I want to go. We don't go where you want to go. And this is something that's really hard for people doing due diligence, especially if they don't have very much experience, is that they get led around by that narrative creation machine of the manager. So my agenda, not theirs. Another part of that is I don't listen to presentations, and we don't do pitch books. I'm happy to see them in advance and take a look at them, but I don't want to be in the midst of your story. I want to be controlling the agenda. And in doing that, I want to follow the script, my preparedness, the prepared questions I have, but I don't want to follow it so completely that I don't see the opportunities for discovery, because I can't have anticipated everything that happens. And so you get to a point sometimes and you say, okay, I don't have a lot of time left here. Do I ask my 6 more questions, or do I follow this thread that's been presented to me? And good due diligence is following the thread, not asking the 6 more questions. So that's a really important thing. Then triangulation of the information. That's why you want to talk to people, as many people as you can, and from different parts of the organization. And then remember that all of this is connected. This is what creates the organization. And that's how you get the best view of the organization, which is what you're trying to do when you're doing due diligence. You're trying to understand the organization. Notice that I didn't talk about investments at all there. So the biggest error that people make probably in due diligence is getting together with these people and talking about investments. obviously, investments are a part of what you're going to be talking about, but you use those as levers to get into understand how the organization's put together, why it's put together that way, what people do, how they make decisions, all those sorts of things. And if you sit around and talk about Brexit or whatever else the concern of the day is, you're never going to get that information. And so you use those kinds of investment sorts of things as a lever to get other information. So that's on site. But then due diligence from a distance, what I call, is when you can't be on site. It's a lot harder than doing that field work, I think. But I think you take all those same principles and apply them. So you don't want to have one channel of information. You want to ask to speak to other people. You want to ask them about things other than investments, because if you get on the investment train, you're not going to get off of it, because they'll take you down so far away from where you need to go, you can't believe it. Differentiating your approach from others is important. Asking different types of questions, asking different people questions. So if I come away from a phone call or even a visit and somebody, doesn't say, "Gee, I've never been asked that before," I feel like I haven't done my job. So you want to be searching for unpredictable, different angles, and you can do that over the phone. Remember I talked about Woodward and Bernstein and All the President's Men. A lot of what they did, the discoveries they made were over the phone. So the phone can still be an effective way of doing that. If you've got a kind of due diligence where you're able, you're going to be coming back. There's maintenance research. You're going to be learning more over time. Don't just go over the same ground. Dig deeper every time. Take another layer off the onion, if you will. Keep going deeper and deeper. And then it's really important to be objective about what you don't know, about what you can't find out from the kind of research you're doing. You need to consider that when you're making your decision. How much do you know? And what have you been able to unearth as a part of your process? If you can't get very much, then you have to be more cautious in terms of making your decisions. And then the third sort of angle is to rely on third-party research firms. And so I think in evaluating their process, you need to understand their methodology. You need to understand their approach to due diligence. You need to focus on the quality of their due diligence, not the quantity. So when somebody says, "Yeah, we visited 1,200 managers last year," that doesn't really mean anything, because you don't know sort of when they go for a visit, how long do they stay. Sometimes it's sort of like a drive-by. They're just checking the boxes. They got there. It depends on who's doing the work, whether it's more senior people, more junior people, whether they've had experience in particular areas. So you need to judge their due diligence efforts, and you also need to understand their business model so you get whether there's any potential conflicts of interest and how they're going to make money with their research. Understanding their track record is important, and to watch what triggers their decisions. So if they are reacting to somebody leaving the firm and performance, that's not really helpful. You can do that. You can react to somebody leaving a firm or to bad performance. So you need to look to them to see what kinds of things they do and what triggers their decisions. So depending on where you are and what you need to do, I think, and really it's in a lot of cases, it's a mix of those three. You might have some opportunities to do on-site. You might do mostly due diligence from a distance, and you maybe also rely on some third-party research firms. So fitting that all together is important if you're doing all three or maybe two out of the three.
Great points. And from a third-party perspective, we get that question or that directive from our best clients. They always say, "Tell me something I don't know. Don't tell me something I already know. I'm relying on you, your expertise, the resources you have to tell us something we don't know." And out of that it comes the value, and that can't be done by that, you said, the drive-by approach, diligence. So a couple of final questions. We're running up against about 40 minutes here. A couple things. One last thing on performance I think it's important to talk about, and I think it's really creative. you mentioned you've already talked about the prior performance pitfalls, but you've also said one good exercise is to design out the performance trap. So talk a little bit about what you mean by that, designing that out of the process in a way so that probably, if I'm hearing everybody's hearing it correctly, it's not beeping at you like it normally does as a siren call to come and try to rely on it, right? So tell us more about the designing out process of the performance trap.
So it comes into play in a lot of different ways and within organizations in terms of how you do it. One of the main ways that performance chasing gets designed in is via screens. So you can go to a firm and say, well, how do you start your process? Well, we do this screen, and all the screens have a hurdle in there regarding some kind of performance. And so by virtue of that, you've designed in performance automatically. And so run the screens, do your work without the performance. Try to do as much work without the performance. Now, one of the things you quickly find out is to say, well, wait a second, where do I start? How do I start? In fact, there was a due diligence firm who wrote something about, and they had this long thing about why not to chase performance, and then they talked about, here's how we go about it. And the first thing they do is a screen. And it says, because you start a performance screen, because you got to start someplace. So they just said, you shouldn't do this, and then they said, you got to start someplace. So the best place to start is to build over time information about the organizations themselves, how they're built, how the people come in and whatever. So to focus on that. So that's one key area. Then at every step in the process, to really challenge each other, to try to figure out how much of an assessment of an organization's performance, philosophy, process, philosophy, process, people, your assessments of them have been affected by this stamp of performance. Because a lot of that is very subtle, is that your impressions of those various categories, and therefore your grades of those various categories, really is affected by the performance. You think they're really smart people because they've had good performance. And so those get linked, and so you have to try to disaggregate that. Then when you get into the governance process, I think it's really important. You ask a lot of people, say, well, how much does performance affect how you make your decisions? And the most common answer is about 20 to 25%. But throughout the process, they've designed in these ways of making it more than 25%. And so there are some ways of structuring the decision-making process where you limit the points, if you will, if you want to look at it that way, that an organization can get simply because of performance. You limit that. And so your decision-making process, and this really gets into the leadership that's involved in making these decisions, has to continually be asking, to what extent has performance affected our decision-making process? And where there are examples of that, you have to just keep pulling them out of the process, out of your decision process. You got to keep pulling them out. So designing out really is trying to ferret out in a given decision process for manager selection that take out those elements that virtually ensure that you're going to chase performance. Now, the end of it is a really hard behavioral task, and that is, can you actually do the most important thing, which is to be willing to buy managers that have underperformed and sell managers that have outperformed? And if you can't point to situations in which you've done that, you're not doing a good job of manager selection. I'm convinced of it. So that's a really hard behavioral thing to do. That's a very good test. And until you can do that, you probably haven't designed out the performance chasing.
Wow. Well, with a most difficult challenge as the last point to make in the call, Tom, thanks for your time today. It's been a lot of fun. There's a discussion we can have about debriefing after diligence processes, and we'll do that. We'll try to do that through a handout that we'll provide everybody here shortly after the conclusion of the call. But Tom, some great points. Had a lot of fun doing it, and hopefully someday maybe we'll come back with a higher level discussion on some more detailed, finer points of diligence. But thanks for the time, Tom. Appreciate it.
Thank you for having me. I appreciate it.
And thanks everybody again for joining us on this May installment. We'll come back again in June, and we'll highlight the topic in the next couple of weeks. Again, if you haven't yet, visit our site, check out factright.com. Again, our blog is available for subscriptions, particularly for advisors, helping advisors and advisory firms with everyday items, not just around due diligence and alternative investments, but hopefully helpful tips that you can find useful every week as we publish twice a week. So thanks again, everybody. Look out for the recording coming up shortly, and have a great day. Bye now.